Hello, this is not financial advice. And as we get started, I'll ask you to like the video, subscribe to the channel, and we're going to jump right into today's topic, which is target stock beating the market. We will take a look just at the overall market today, up 0.22%. Target stock up today, 17 and three quarters percent. This is going to be based on earnings. So Target reported quarterly earnings today. They were expected to do 2.52 billion in revenue. They did 2.54 billion in revenue. So three quarters of a percent or a two-thirds of a percent beat on revenue. But the real surprise to the market, leading the stock up 17 and three quarters points, was Target's renewed profitability. EPS estimates were $1.48 per share, reported as $2.10 a share, so a 42% beat on earnings. Let's get over here and take a look at Target on Qualtrim. We understand that the stock is trading at $130 today, up 17 and three quarters percent. So that's the price of the stock. What we also want to make sure we understand is what the value of the stock might be. So let's zoom out on this map, and we can see that the stock had been a pretty slow and steady performer for the longest time. And then around the pandemic, they really shot up, very, very overvalued at times. And now we're looking at a little bit of a mean reversion. So if you just follow a trend line, it's very imprecise, but we can see that the stock price has been up and down. At certain times it was overvalued, at other times it was very likely undervalued. And we're sort of having a mean reversion right now, but we still need to check what the value of this $130 stock is on a per share basis. So, as always, we're using Qualtrim software. It's a piece of software that I pay for, not one that I'm affiliated with. I will leave a link to Qualtrim below if you'd like to check it out yourself. Um, but yeah, I'll ask you to like and subscribe to the video, and then let's start digging into some of the financial performance of Target to see what's going on with this company. So, looking at Qualtrim, we'll remind ourselves here Qualtrim's reporting Target shares are trading higher after the company reported better than expected Q3 financial results. The company will offer more than 10,000 items for the holidays. That includes exclusives and many items priced under $25. So if you're a human that's today alive in America and you understand inflation or disinflation and fear and greed and just where we sit as a country in late 2023, that sounds like a pretty good game plan to me. So let's take a look at the revenue on Target. Over the last 5 years, this company has done really well. So pre-pandemic, 75 billion in revenue, a big gain during the pandemic, and then revenue. They've reached a new level of revenue, which has held steady as the pandemic had started to wind down, gaining fiscal year 2022 to 2023 by $3 billion, now sitting well over their pre-pandemic highs, holding the increase in revenue they earned during the pandemic, now at about $109 billion in revenue for the current fiscal year. So up around it's around 8 or so percent per year revenue growth on a discount retailer. That's exceptional revenue growth. 8.46% over the last 5 years. That's pretty exceptional growth for an older discount physical retailer. So let's get an understanding of some metrics that matter using Qualtrim. We're going to highlight some metrics that matter at a glance. Forward PE 15.2. That seems pretty reasonable. Decent little free cash flow yield of 2.4%. The company has a lot of debt. They probably have a similar or better credit rating to the United States government, so I don't think that they are going to be like Sears. They've got a decent amount of cash on hand, and this is something that we're going to talk about. A massive starting dividend yield due to the historically depressed price. So a starting dividend yield of 4.1%, that's absolutely huge. A lot of that is going to be due to the fact that dividends are paid on a per share basis, right? So the the price of the stock has gone down probably over 50% from all-time highs. See, that says 261. All right, so I was at 261. So the max drawdown on the stock right now is, yeah, 50.1%. Um, so when the stock was 50% higher, that dividend yield was probably around 2%. Now it's around 4%. And so this is definitely a pretty awesome looking dividend stock. We can see that their payout ratio is a little bit high, not super duper concerning, but 58% payout ratio. This would be a good time just to show you from a little bit of searching that I did what I came up with. So I thought it was the case, and in fact, it is that Target is a dividend king. And so being a dividend king, what that means is that they've maintained and increased their dividend on a annual basis at least for over 55 years. So Target is a strong dividend paying stock, and that is where some of its value um, depending on who you ask, that's where some of its value is coming from. So let's take a look again at the revenue on the company. I think it might, since everyone's been calling a recession for the last 3 years, let's take a look and see how Target's performed during past recessions. So we had in 1999 and 2000, going through 2003, we had the tech bubble and a little bit of a recession after 9/11. So in 1999, they had revenue of 31 billion. 2003, 31 billion in 99, 2003, 44 billion. So they did well in that recession. Let's look at 2007 through 2010, financial crisis, banking crisis, international, whatever they called it, crisis, recession. 2007, 59.5 billion in revenue. 2011, more, 67 billion dollars in revenue. So this is a company, we'll take another look. 2019, 75 billion, 2021, 94 billion. So this is a company that's incredibly resistant. And if you saw the graphic and that was part of why you clicked on the video, hit like and subscribe. But here's my investing thesis on this company. Um, Upper middle class suburban women not only determine elections in the United States, they also control the bulk, maybe 51 or 60% of consumer spending. So, upper middle class suburban women love Target. That's the whole thesis. So I'm an investor in Target. I probably have it about equal weight to the market. I should have overweighted it, but I didn't for reasons, but I'm not mad. I'm not mad at it. So we can see here how resilient these revenues are. Let's take a look at the free cash flow. So this stock shot up and then shot down. So one thing to understand about Target, they're a physical retailer. Okay, we're going to come back to this. They're a physical retailer, but during the pandemic, they shifted more to online. They also have in-store shopping. They have order online, pick up in store, and curbside delivery. So they have 3 or 4, 5 different ways for you to give them money, which is fantastic. They have a loyalty program, which is fantastic. I'm confident they have a partnership with Starbucks. I also believe they have a partnership with Ulta Beauty, as well as many celebrity influencers have exclusive lines at Target, and so this is something that further differentiates Target from, say, a Walmart. So this is you always want to make sure you're not investing in a company like Sears that goes to zero. And I think the future of retail is online. That's why my biggest position is Amazon. What if I'm wrong? I also hold companies like Target and Williams Sonoma and others, Dollar General. So we understand there's a bunch of different ways that you can give Target money. Let's just sort of scroll through this. So FAO shorts, fake Christmas trees, kitchen items, 30% off TVs, kitchen stuff, basketball hoops, Thanksgiving, pumpkin spice, toys for the kids, lots of sales and discounts, PJs, fake Uggs, store brand. It's already Christmas. They're probably playing Christmas music right now. Okay, so you get the vibe. Kendra Scott, it's Target. You get the whole vibe. So I'm all about this company to that end. I do own some, not enough, probably about equal weight to the market. But I've got about 375 bucks in Target stock. I'm up about $60 today on Target stock. So bittersweet. I'm happy about it though. I'm just more happy really to bring you this information about the company. So when we look at the price of this company, some weird things happened. So, a lot of defense people shopping for um, milk, eggs, bread, cough syrup in the beginning of the pandemic, stimulus checks, people buying, electronics, other nice things for the home, TVs, etc. And then we had supply chain issues. And so there was a point, maybe about a year and a half ago, where there was such a demand for hard goods, such a demand for hard goods like TVs or microwaves, um, that Target ended up ordering a bunch of it showed up. And at that point, people had already bought all the nifty gadgets with their stimulus checks. They ended up holding the bag on a lot of hard goods as consumers shifted more to staple goods, milk, eggs, and bread again, and cut down on their consumer spending. And that's why the price shot up and then the price shot down. That's my belief. That is my belief. And so recently, the CEO had given some guidance like, hey, you know, we made that mistake. We ordered too many hard goods. We couldn't time the demand of our consumers, which is a red flag for me. That they over ordered hard goods, but Dollar General did it as well. And so that, alongside with some of the comments made by the CEO, just made me feel a little bit leery. I've got a lot of exposure to retail because that's my circle of competence. So, um, although I saw an opportunity and I held, I did not add to the position for those reasons, which is fine. But let's take a look at the free cash flow of the company. Ultimately, that means everything. So, the free cash flow of the company is up and to the right. What happened here is in the first few quarters of of this current fiscal year, having over ordered hard goods and having to discount them. But overall, the trend line is up and to the right. And we can see, not sure exactly how updated this info is on Qualtrim, but let's just see if we can take a look at the free cash flow on a quarterly basis. So there were some big issues, and this is when the stock price went up with free cash flow. This is when it went down, but now we can see that this looks pretty good. So that's third quarter of 23. Let's go back 5 years. Third quarter of 2019. Third quarter of 2019. So still down from there, but they're doing some recovery. So the free cash flow overall, it looks good. It doesn't look great, but this free cash flow looks like the trend is correct for me. So that's a check mark. The revenue going up again, also a check mark. Liking and subscribing this video, also a check mark. Let's look continuously here at metrics that matter. So a big dividend paying stock. Um, we can see they've been increasing it. Uh, Dividend growth rate over the last 10 years at 9.9%. So 3xing the paces of inflation, you get dividend hikes, increases in your dividend income stream from Target at 2 to 3x the rate of inflation in the last 10 years. That's absolutely fantastic. That's where some of the premium on this stock comes from. Although the PE multiple is really pretty appropriate. So this is a company that's also buying down shares. We love that, buying it back about 3.5% of their shares on an annual basis. That's a check mark. Let's also take a look at their ability to take our invested dollars or debt they take out from a bank and their ability to reinvest that profitably. So even as they're having problems, 11.4%, which isn't horrible, but an average high teens over the last 5 years on return on capital employed, that's quite good. Let's take a look at the profit margin, should be the bottom line of their profit margin. Um, an average of about an average of about 4.5% over the last 5 years. So that's another reason that I hold this company. I think that they can charge higher margins than other retailers. And one of the main problems with retailers is their ability to is their ability to, charge a premium or increase prices when their prices are increased. Their ability to pass along price hikes to consumers. How well will that be tolerated? So think about a shopper that you see at Walmart on a Saturday afternoon versus a shopper you see at Target on late Wednesday morning. Just think about how that person seems and appears to you, and you'll have your answer. So, profit margin on Walmart, for instance, last 5 years, an average of only 2.4%, right? An average of 2.4% over the last 5 years. 2. 2.4% versus what do we just see? So 2.4% on their bottom line profit margin. And let's just be reminded, goldfish memory. And then so 4 4.6%. So about 2x the bottom line of profit margin on Target. That's why I own Target and Dollar General as opposed to Walmart. That's just me. So check mark on the profit margins. The debt is high. That's an X. That's not great. Don't love it. And then let's take a look at the historical valuation. So price to earnings over the last 10 years. Let's look at it over all time. Price to earnings. So this company likes to trade in this 15 range, and currently it has a forward PE of 15. So it's trading on a forward PE basis, essentially in line with its historical PE multiple. So that'll be a wash. But it doesn't necessarily suggest that this isn't a time that you could add to, or at the very least, hold your position. So, more good than bad on this stock. Let's take a look and see if there's any type of activity. So, a board member, Cornell Brian C. Cornell, sold shares. He sold $4 million of shares at $130, which is the current price of the stock. He did that just a few months ago. So he probably got his first yacht. Congratulations, Brian. Let's like the video, subscribe to the channel, and we're going to keep it pushing. Before we can unlock what the fair value estimate of the stock is, I'll be showing you that there at the end. And so, executives selling at the 130 to 165 range. So not seeing insider buys. Um, might suggest the stock is at a little bit of a premium, but we're going to make our own determination. We've got the vibe of the store. Those are some of my holdings. We saw that. Okay, so we've done all that. Price of the stock is $130, up almost 18% today. Let's take a look at what the value of the stock is on a per share basis. This is data that I got from Qualtrum a couple weeks ago. Should be mostly up to date. May not have included this most recent quarter, but when I'm looking out 5, 10, 20 years, it's essentially essentially irrelevant. So free cash flow in the company about $3.5 billion a year. Cash on hand 1.6 billion. Debt $15 billion in debt. That's too much. But they probably have the same credit rating as the US government. Recently they had 461 million shares. Now we saw that the growth rate was about 8.5% over the last 5 years. I made some pretty conservative assumptions, thinking that that bump in retail spending with COVID wouldn't be sustainable. So I put in an input of 6% growth over the next 5 years, years 6 through 10, from 6% down to 5%, and then 3% or just GDP terminal growth multiple, 10% discount rate. Price on the stock $130. Value of the stock 105, showing that we are somewhat to moderately overvalued here. Let's play with some of the assumptions. So let's give them a little bit more credit on top line revenue growth since they've been doing a good job. Let's give them a little bit of a premium on that terminal. In fact, let's keep that the same. Let's give them a little bit of a premium in their revenue over the next 10 years, showing 115. understanding that this is a company that has decent returns on capital employed, has a nice safe dividend, is pretty resistant to recession, and I would argue has a narrow economic moat. Let's let's reduce our required rate of return under the more aggressive revenue growth and lower required return. The stock would be undervalued at this time. This would probably be how Wall Street would look at the value of this stock, and I bet you the price targets on the stock would be somewhere around this 190 level if I was to check or care about price targets, which we shouldn't. So let's keep the lower discount rate, but then let's go back to our uh, original conservative revenue growth estimates. And in that case, the stock price is still undervalued. So, what I would say is that this would be somewhere between a hold and a overweight. I hold on to this position. I had added earlier, and so my average price is probably closer to 150. So, with this price having come up 20, 20 almost 20% in one day, here in the next 2 days, it might whatever goes up comes back down. So I may add a little bit more here as I'm getting that confirmation in the market that my thesis is correct, that Becky and Karen beat the market when they shop at Target. And so that is it. Let's come back. We're going to do a new segment on these episodes and end the video looking at the heat map for the market today. And so, we'll just talk about it. If you look on your bottom left hand part of the screen, you can see that financials and banks did really well today. Additionally, we saw home improvement doing pretty well today here and here. We had some great stuff happening in the farm and railroad space. We had strong performance in telecoms, entertainment, uh, decent performance in healthcare. But what we're seeing is a little bit of a it's too soon to tell, but a little bit of a reversal in the trend with information technology and chips down for the day. So the rally seems to be continuing to extending. Market up 0.22% today, target up 17.75. Like the video on the way out, subscribe to the channel if you learned a single thing in this video, and I will see you on the next one. Thanks. Bye.